Hey, very good afternoon to you traders. Mark here from the Day Trading Room. Wanted to talk a little bit today about unexpected response on a higher time frame. Before I do, thanks for your messages, emails, etc. inquiring about what I've been doing. I've replied to you if you've messaged me. Just to update you, I'm still here, I'm still trading. I'm just not as actively trading as I have been. I mean, it's the first time in my 13-year trading career that I haven't spent most days in front of the screens watching the ebbs and flows of the intraday market moves. I'm picking my spots a little bit more carefully. I'm stepping back a little bit, not being as involved as much, and just trading when I think there's opportunity. I mean, the market's the actual broad stock market's not going crazy. We're not having huge sell-offs. We have picked up a little bit more volatility the past couple of weeks, admittedly, so keep my eye on that. When the opportunity really starts to pick up, I will be right back at it and putting in the screen hours. But at the moment, I'm really quite happy just to pick the spots, and this is pretty much what I'm going to share with you today. Some of the things that I look at to pick my spots on a higher time frame, and then I will come in and try and time that on a shorter time frame, maybe take some risk off the table, the scale, and then step back and then see where we are at the end of the day or the next day or what have you. So a slightly different way of approaching trading for me, but it's I'm more than happy with it, and it's not a change as such. It's just a different strategy and different approach for me. I'm sure when we pick back up in volatility, I will be here as per usual, sitting in front of the screens, but at the moment I just don't feel the need to. So that's while less videos, just less general involvement in the market, just doing other bits and pieces, but still very much aware of what's going on. So okay, let's talk about this unexpected response. Now, those of you who've done the tape program, you're going to know full well about this, because on a very short-term tape basis, order flow basis, that is when we see something that we expect the price or the tape to go one direction, i.e., let's say loads of buyers coming through streaming green, yet the price backs off. That's a prime unexpected response. We talk about that a lot, about how to take advantage of that sort of thing on the tape. But from a higher time frame perspective, how can we position and what sort of things can we look for? And I'm going to show you a few examples, broad examples today, and we're going to keep it brief as we can. Not going to go into massive depth, but just really the idea is that how do you pick markets, stocks, commodities, whatever it may be, to trade? How do you decide? Now, we've all got various strategies and setups that we use, and perhaps this is just one more thing you can put in your arsenal of trading strategies and ideas. And it's quite a good thing from a part-time perspective. If you're doing something else, if you're working, if you're running a business, if you can't be at the screens all day every day, or if you just choose not to be, then this may be a filter that allows you to gives you a heads up and say, hey, I might want to get involved in this because it's it's quite a good, potentially a good opportunity. Okay, so unexpected response, we can define it in a way. I've really got a really good, concise way of defining it, but in reality what it is if you have a piece of news, it's at the higher time frames, by the way, if you have a piece of news that should affect the market or should push the market in one direction that doesn't, and the market moves in the other direction, that's unexpected response. So the expectation, if you have a really bullish piece of news coming out on a stock, you should push the price upwards. It's bullish, whatever it may be, whether it's good earnings, whether it's they've got a new deal, whether they've won a court battle, or whatever it may be for a stock. Same with the markets or commodities. If a crop has been if a wheat crop has been significantly damaged by a storm, then obviously it's going to have less wheat and the price should push up. That's your expected response. It's when the opposite of that happens, it's unexpected response. So bullish news, the market goes lower. Bearish news, the market goes higher. Does the opposite to what everybody is expecting. Okay, so let's look at a few examples. I've got a couple of broad examples here for you, and I've tried to find a couple of recent examples on stocks, and I can only find ones that I remember doing back on some UK stocks a couple of months ago, and I'm not going to really put those up because I know that most of you guys who are watching this aren't that interested in UK stocks. We can go with some of these broader examples, and I think you'll get the idea, and we'll talk about how it applies to individual stocks as well. But I think the most recent example, which is probably one you may well be aware of, you may not, doesn't matter either way, we can run through it, talk about it. Okay, this is the pound against the dollar, so Great British Pound against the US dollar, otherwise known as cable. And we've had, regardless of what's happened here, forget about this, forget about all this, around this sort of area here is what we're interested in. Now, there are many reasons that this currency is moving the way it is, and we're not going to go into each one and argue about that, but one of the factors from this sort of period onwards, this area that I'm highlighting here, it's looking a bit messy, isn't it? But that area there highlighting there is the Scottish referendum. You may have known about this, I'm sure you've read about it, whether you are in the UK or not. Scotland were voting whether to become independent from the UK or not. Now, general consensus is if they did become independent, that is going to be push the price of cable down, so this chart down. If they were going to be remain part of the UK, that was going to help push the price up. That's a real generalization. I know that I'm going to get probably comments about that, but I'm just generalizing in terms of, I know that currencies have different effects to them, but let's just keep this general for this example. We'll talk about some more specific ones in a minute. So this is really what happened here. Now, at this point here, if you can see down here, we started to push back up as the polls, the telephone polls and the face-to-face polls started to indicate that Scotland weren't going to become independent. In other words, strong for the pound against the dollar, going to push the price back up to the high side. So that was why we had that little push up there. And this day here, you can see with the wide range and the wick to the high side is all down to the actual date of the referendum. So the no vote came out, they weren't going to become independent, they're going to remain part of the UK. You know, that's bullish for this chart. Okay, just keeping that as a rough example. It's bullish for this chart. However, in the subsequent days, we then started to roll over. That's your unexpected response. If you're long before the day of the referendum thinking, okay, they're not going to become they're not going to become independent, this is going to be good, we're going to push back up, we're going to see 166, 167 or whatever it may be, and then it doesn't happen. Just think how those people are feeling. They've had bullish news, they've had the news they were looking for, the news that they expect to push the market up, and it doesn't, and it rolls back over. So they are the first ones that are starting to liquidate. You know, this unexpected response, the expectation is going to push the price up, and yet it doesn't. It actually pushes the price lower, and in actual fact we ended up taking out the lows when we were expecting, there was a bit of a fear that they were going to become independent. So it's just showing you exactly who's in charge, or where the bias is, or who which side of the bull or the bear side is really commanding the price movement. Okay, so that's a broad example. Let's have a look at gold, another example. Now, I don't have a continuous contract on Interactive Brokers here. I've just loaded this up for this video. I don't have a continuous contract here, so the shape of the chart is going to be bitty because it's in December, which is the front month at the moment, so it's not quite accurate, but we're going to get the idea, because if we push further back we should be in the contracts that had the most volume, but you get the idea. So anyway, we know they had a geopolitical unrest in Russia, Ukraine, etc. over summer, and gold really could not rally. You know, we couldn't even get a good rally going. We were pretty much where we were at Easter at the beginning of the year, and this is a very difficult thing to time for a 2 or 3 day trade. The stock examples we're going to give in a second are better for that, but it's the same idea. I just want to show you some of the ideas behind it. That, listen, we had plenty of reasons for people to buy gold. Unrest across many continents, a lot of uncertainty there, and gold is generally, as we know, a thing where people will put their capital, if it's the fear trade, isn't it? They push their money into gold because, you know, it's relatively safe. They can hold gold bullion, they can store a lot of their wealth in a relatively small area. Yada yada, we know the story behind that. But gold just couldn't push up. In fact, it started pushing lower despite the unrest. Again, that's your unexpected response. Not an easy trade to time because it happened over a several week, several month period almost. But you know, the idea of the trade is there. You know, if you're having a lot of bullish news for gold that can't push the price into a rally or out of a range, then what's going to happen when the news turns, or what's going to happen when the news backs off a bit? you can assume, or you can't assume anything in trading, but you can perhaps infer that the price is going to go in the opposite direction, because even with that pressure to the upside, if it can't push up, what's going to happen when that pressure backs off? It's going to push to the downside. Another quick example is obviously, many of you are probably thinking this right now, crude oil. Where's crude oil gone? It's moved. There we are. Crude oil, same sort of thing. Loads of unrest. We had ISIS that were taking over oil fields in Iraq. We had the Russians that were having words with the US and Europe about the Ukraine issue. Lots of reasons to be bullish on oil, yet it couldn't rally at all. And this was a great example. It just was been in a downtrend since sort of middle of June, early July. That's another example. With all the pressure coming in from the news, it couldn't push the upside. For whatever reason, people were not buying crude oil. So, you've got that one. Now, if you look at a specific stock, and I as I said, I did have a couple of examples, but I'm going to just talk broadly and just look at GoPro here. This is not a perfect example, but you get the idea. Now, the way to look at it with stocks, and I actually prefer this unexpected response with stocks, because you tend to get it's more exaggerated because of the participant type involved in it. But let's say you have good earnings coming out on a stock. So you have good earnings and the price just maybe gaps up initially in the day, so it's been doing this. There's your earnings gap, and then it just rolls back over. And this was Sainsbury's a couple of months ago. It gapped up 5% or so and pretty much sold off, and before you knew it, it was back to where it was pre-market. That's with the good news now in the stock. So good earnings, good news, it was being sold, and the subsequent few days the stock just got hammered, because even with that pressure or expected pressure of good news, it couldn't. There's your unexpected response. So at that point, when you start to see that, maybe if it crosses the gap level, maybe if it just starts to stall, whatever, there's your trade idea, and you can fine tune it and take the setup as you prefer, whether you want to trade it intraday, whether you want to position with a swing trade, however, whether you want to position with a put option, that's just as valid if you can't be in front of the screen, whatever. There's loads of ways of capitalizing on it, but it's giving you a bias for the trade. Now, similar one for GoPro, some pretty weak news came out of it a couple of days ago. Can't quite remember what exactly it was all about. Let me just see if I can quickly get it. I will try to find it. There you go. I remember now. It was that there was going to be, the lockup period was going to be reduced, and there was potentially going to be a lot of shares put into the stock from the founders or something along those lines. I seem to remember a charity being involved. It doesn't matter. Anyway, whatever it was bearish news for the stock. In other words, there's potentially going to be stock being sold into the market. And of course, that day we saw a 12-15% drop, went to 79, ended the day back up. Didn't end positive, but that's a pretty bullish candle right there, the one I'm highlighting. And then subsequently, we've pushed up to the highs. So in other words, even with this news in, okay, because that's the close before we had the news, this is the open after the news, even with that bearish news on the stock, we're now above that price. So it's absorbed all that bearish news, and the price is still higher even with that supposed bearish news coming into the stock. This is your unexpected response. The actual expected response to that would be selling and further selling, and it just shows you how important it is, and that's really giving you a pulse of who's in control of this stock at the moment. If you can't even see it, if you couldn't see it from the chart itself, and if you were thinking, this is perhaps going to change sentiment, the fact that you've got that information coming out on the stock, and the stock then rallies from that information. Okay, we did have a little bit of a flurry to the downside, but after it's settled and all the day traders are out of it and all the short-term guys are gone, it settles above. There's your unexpected response. There's your bias and trade. Now, that's not a perfect example, because it wasn't that bearish, the news. It wasn't like they missed earnings or they lost a court case or something critical. It was reasonably bearish, so it's not quite as powerful. The more important the news and the more exaggerated the move against it, really important news and perhaps rallied on really bearish news would be a perfect trade, if you like. But I hope that gives you an idea of the sort of thing that can present opportunities on a swing basis, and it's a good way of filtering. You can keep an eye on the news, you can keep an eye on the gaps of the stocks, and then cross-check it with the news, and then perhaps stocks that have filled gaps, then have a look at, if you can't get back until the end of the bell has gone, perhaps look at stocks that have gapped and have filled those gaps, then look at the reasons for the filling of those gaps. If it was weak news and in fact ended the day where it was before the news, then there's your unexpected response, and you can perhaps factor in, or you can perhaps create a trade idea around that. So that's a different way of thinking. It's not a chart pattern. It's nothing to do with moving averages. It's nothing to do with support and resistance. It has nothing to do with the traditional things. It's just a new way. Well, it's nothing new either. It's been going for ages, but it's perhaps a different way of looking at price action and utilizing gaming theory of thinking who is positioned on the other side of the trade, and giving you a bit of an insight into, you know, the strength or weakness of that stock or that market. So anyway, I hope that's given you something to think about. If you've got any comments, questions, or ideas, any strategies yourself you want to share, please feel free to email me. Go to the site, daytradingroom.com, you know the address, contact form there, or those of you who've got my email, fire away, or you can catch me on Twitter. Good trading, guys. Please keep the risk managed, whatever strategy you use. Risk management is so important. If you've got no capital, you can't trade. So keep it tight, keep the risk managed, and make the losers not matter, and make the winners count. And you know, it will be a good year. Take care.